Hello, and thank you for joining us for a brief update on our outlook as we enter the final quarter of the year. I'm Tim Chubb, Chief Investment Officer here at Girard. The last 3 months have validated our perspective this year. Inflation has proved stickier, and central banks have needed to maintain their path tightening financial conditions, causing interest rate volatility, and as a result, another bumpy quarter for stocks. As we enter the fourth quarter in a defensive position, let's review our outlook for the rest of the year as investors continue to look for peak hawkishness from global central banks. As always, please visit our website, meetgirard.com, for more economic and market insights in addition to topical wealth planning thought leadership from our advisory team. We closed the last market update with this slide, which summarizes our view of the economy and markets. The outlook for the market and economy we laid out for the last quarterly update largely remains unchanged. Data most significant in shaping our economic and market outlook has worsened, with the U.S. leading economic index declining 5 months in a row, and the OECD Global Leading Economic Indicator Index declining for 13 months. Inflation has likely peaked and is beginning to decline, which will reduce the future need for the U.S. Federal Reserve and other global central banks to continue tightening. Still, the window for a soft landing, where the U.S. avoids a recession, has likely closed as policymakers will be unlikely to achieve slowing growth to below potential while loosening the labor market enough to temper wage growth and inflation. Heading into the fourth quarter, the persistence of inflation and continued tightening of financial conditions raises the risk of a recession in the U.S., but in Europe, challenges of the energy supply and cost issues make it unavoidable and is likely underway. China looks set to grow at just 3% this year, owing to weakness in the property sector and ongoing COVID-related activity restrictions. Inflation has remained elevated, and for the broader economic environment, most notably the labor market, which the Fed views as the conduit to higher prices, has proved resilient. As a result, central banks remain on a hiking path, with policy rates expected to rise to a higher level than anticipated last quarter. The risk is that they go too far too fast, given that monetary policy impacts the economy with a lag. This recent quarter marked the third consecutive quarter of negative performance for the S&P 500, which has not happened since 2008-2009. While the current macroeconomic environment is bleak, we continually look beyond the present to anticipate the future. In our experience, stock prices in the near term are strongly influenced by investor sentiment, which can be driven by various factors. When the market appears focused on present circumstances, long-term investors can position themselves for future opportunities at discounted prices. However, in the long term, the enduring factor that outlasts the ever-evolving narrative is the fundamental earnings power of the companies. While corporations have been slow to forecast lower earnings next year, global corporate earning downgrades have actually outpaced upgrades for 6 consecutive months, and S&P 500 earnings expectations have now declined for 2 months. These developments are consistent with the economic environment and are necessary for stocks to bottom. Against this backdrop, we remain focused on companies with strong earnings visibility, recurring revenues, and balance sheet strength. Small cap stocks also have attractive valuations, with the S&P Small Cap 600 Index trading with a price-to-earnings ratio of 11 times, near the cheapest level in the last 30 years. This discount is likely reflecting concerns about earnings, but like cyclical stocks, the risk-reward is becoming more compelling. Global investment-grade bonds have fallen a full 19% since the start of the year, and when measured from the historical high at the beginning of 2021, the index is in a bear market, a decline of more than 20% from its peak. Since long-dated bonds tend to suffer the most from interest rate hikes, it's no surprise that 30-year treasuries have experienced a negative return of almost 40% since August 2020. Interest rate volatility has been heightened as investors swallow interest rate increases from global central banks, but our investment team believes the market is near the end of this tightening cycle, providing a ceiling on rates. With the 10-year treasury starting the year at 1.5%, now 3.5%, and the 2-year just over 0.5%, now 4%, real rates, that is, the yield minus the expected rate of inflation, are now positive across the board in various fixed income asset classes for the first time since really the last 15 years. Credit fundamentals are relatively strong historically, especially as companies have had ample time to prepare for the impending storm and have benefited from the ability to borrow at extremely low interest rates over the last 10 plus years. Stay tuned next week for the last of our investment currents video series for the quarter. We'll dig a bit deeper into the dynamics affecting the investment landscape and what history tells us about where the markets are headed next. As always, we're here to help. Please reach out to us on meetgirard.com to learn more about our approach to fit your needs.